Good morning, good afternoon, and good evening, everybody. Hey, welcome to this episode of the Note Closure Show. As always, Scott Carson, excited and jacked up to be with you here today. And we've got a couple special guests on this episode. Now, I know I get a lot of questions. People are like booking calls me. How do we raise capital? How do you raise capital for larger projects? And then we had people like, hey, how do you tap into like family offices? Or what do you say when you go talk to these guys or gals that are running these things? And it's a different ball game. It's a different story. So we've got the two head honchos, the chief bottle washers out of BlackBridge Capital joining this morning. It's Thomas Black MD and Cole Ridge on there this morning, guys. What is going on, man? How y'all guys doing today?
Doing good. Thank you very much for having us on, Scott. Appreciate it.
No problem. So tell the audience out there, guys, kind of what you're doing at BlackRidge, and then we'll go into your, origination story, how you became a superhero.
Yeah. So Cole, I will take this one if it's fine with you. So
Fire away.
yeah, so BlackBridge is fairly new. I think it's an amalgamation of kind of Cole's past and mine. It's really centered around our personal, net worth first. As a family office from the last probably decade and a half of capital raising, of creating a fairly substantial fund. I think that, my background, I did about 32 different funds and we've sunset that now. And so we got to this point where, as everybody knows, the last 3 years have been a little interesting and trying comparatively. So we really got together and aimed to look at changing the course of things and kind of risk stratifying some things over the lessons we learned for the last decade. So
Yeah, 32 funds, you'll learn a few lessons there.
just a couple, just a couple.
Have
There's
you
some
written
good
a
times and bad times, and that's what you got to realize. Nothing is perfect forever, and that's the most important key, right? There's always ups and downs.
Amen to that, definitely out there. What do you think has been what made you interested in going down that route? Because you guys have a different little kind of origin story. I mean, you're a medical doctor, still a doctor, but not practicing. Is that right? Not doing surgery. Is that right, Thomas?
Yep, no more. Yeah.
And so, what led you from? Because you were in the military to begin with, and then what's your kind of path to where you're at today?
Yeah. So first, I started out as a unbelievably horrible high school student. Like, I mean, bad. Like barely passed high school, kind of a thing, right? 750 on the SAT, and that's both sections combined. Joined the military because I couldn't even have got into technical school. My brother and I were the same way, and my sister too, actually. So all of us ended up in this really tough grit at the end of the day, and that's what's really important. I joined the military, discovered that it was a motivational issue, much more than an intelligence kind of an issue, and got my rear in gear. Applied to the Naval Academy because I thought I was going to be a pilot, and made some really choice personal decisions and got removed from the Naval Academy before I even stepped foot on campus. Ended up finding myself haze gray and underway on a destroyer for 3.5 years and did a couple of tours, and got this great idea when we were in the Persian Gulf of, hey, I'm going to be a doctor. So for a kid that couldn't go to college, it was kind of a pretty big aspiration. So worked at it, got out, went to undergrad, graduated top of my class, went to med school, graduated great, went to emergency medicine, and then realized, holy cow, I kind of don't like this. And so then changed careers, started buying single family homes, using them as rentals. And that was, 2008, 2009. Had partners that are watching what I was doing. And so from that, the birth of the prior company that we had, just took off. It was this, kind of the early syndication days. And I use that a bit as a bad word these days, just because there was so much that happened the last probably 5 years and leading up to this, the prior 8 were great with the Jobs Act. So, that's really where the infancy of everything started. And so as we sunset that company, it became a little different. And that's where Cole and I actually met. And I'll let Cole, since I've been talking the entire time, kind of introduce himself and tell you, how this has come together.
Yes, sir. Mr. Oliver, take it away.
Yeah, I appreciate that. So BlackBridge to me is just like he said, a very natural progression from what both of us were doing. In my previous role, working more in the energy space of private equity, I was so focused on finding capital partners like Tom and other syndicators. And like he just said, syndicator, if you say that to someone that's raising capital today, it does have that connotation where they're like, oh, no, 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 no. I'm the general partner, or I'm a head sponsor, or whatever, you know, kind of Windex they're trying to clean that stain off with. And it's just window dressing. But at the end of the day, they're just syndicating capital. And so when I was looking for people like Tom that had a base of high net worth individuals that were looking for deals, I got exposure to a wide variety of investments outside of just the energy space that I was in day to day. And also, you got to see what investors liked about certain syndicators, what they didn't like, what were the hot topics at any one period of time. I think we saw a tremendously long run of multifamily being just can't miss. You threw a dart, you were going to hit and have pretty solid cash flow for a period of time. We saw what happened when interest rates and COVID and the housing rush, all of those factors have put a lot of strain. And to Tom's point, we've seen a very volatile last few years when it comes to the traditional multifamily syndication. But we also saw kind of like flash in the pan trends like car wash funds, which are now extremely saturated. A lot of storage out there, a lot of ATM funds that were kind of crazy for a period of time when we're all talking about crypto and going away from physical cash. Let's start going back to physical cash and putting ATMs out there. So it's just weird to see how easily people just flocked to like whatever idea was being pitched that day. And I think when times are good, you can get by passing off a lot of crap as a solid investment. And so what I learned is I don't want to hit home runs or try to hit home runs every single time. I just want to put together something safe that our investors can rely on that's hitting singles and doubles. And that's basically what we've learned is how do we mitigate our downside? How do we navigate times when the market around us and the broader economy and the broader geopolitical landscape can all be in crazy times, and we still have cash cows that are slowly chugging away. And that's really
Mhm.
kind of the focus for me, at least moving forward.
No, it makes a lot of sense there. What would you say for those that are listening out there that are looking to raise capital? Cole, and I'll ask this, have it come to you, Thomas, because you guys have a little bit different viewpoints, stuff like that. What are some of the things, maybe hot buttons you should talk about, or maybe some of the things you should not say, besides saying I'm a syndicator these days? What are some
Right.
of the things to help raise capital in today's market that you found works well?
I think first of all, I think it's a great question. And I think that it's evolving, right? I think what you're seeing the last year, is a lot of things are being dealt with. I think that, depending on who and what experience they've had, um, I think being genuine is the first thing, right? And I think it depends on what kind of company you've run. For me personally, it was always about the company and the assets. It was never about, unfortunately, the education and the master class and things like that. We were always singly focused on operations, which got really hard. And I think that now I double down on operations because that's where the core of everything is. When things get hard, you better know how to operate. And so in the doctor space, the last 5 years, we saw this proliferation of just everybody getting outside. I'm an anesthesiologist, I'm a surgeon, I'm this and that. And it always kind of surprised me that everybody's running from something instead of running towards something. It was always a different ideal for me. We raised about $125 million between 2014 and 2020, right as COVID. We didn't do so much after that, thank God. We started to level back and actually started to reduce the portfolio and to divest about 2021. So when 2022 came along, we weren't completely unscathed, but it's communication, it's being genuine. And I think it's really, really, really important to dive super deep on the due diligence now. I mean, an economy and cap rates were great, but nowadays they don't wash away the sins of underwriting, and everything is conservative underwriting now. You're seeing those Peter Schiff type personalities in underwriting coming out going, "See, I told you so." It was going to blow up at some point. You're like, no, you're right. I mean, everything ebbs and flows, right? And people get swept up into that. So if you're trying to raise capital today, I think you start small and you have a large contingency and you then produce on results. I don't think you can move fast. I don't think that just talking about raising capital, I think you have to put time and effort and proof. I think proof is the biggest thing. And that's tough when you're up against time and trust. Trust and integrity are hard. You're gonna make mistakes. Things happen. You cannot assess and have a contingency for every single thing. You have to remain calm and navigate through it. And when those things happen, being honest, transparent, and upfront mean the world. Just communicate. Most people understand when there's problems, but they don't when you try and bury them or sugarcoat it. That's the hardest thing. You got to be upfront. You got to inform. You got to communicate. So,
Amen to
Cole, I'll
that.
let you go. I mean, you're nearest the space too.
Okay. So authenticity and integrity, I think, are the two things that I look for the most. And what's interesting is we are kind of acting like a regular LP investor when we go out and conduct due diligence on the funds that we're looking at bringing into our products. So I think that gives us that unique perspective of the same way that we would want an investor that works with us to do due diligence. We're doing that into the sponsor of the individual asset class that we're looking at. And so that importance and the shift of due diligence, I think, can be looked at of what is the performance in, when everything is running wild and everything is hitting. And then what was the performance over the last 3 years when everything else was tanking and freezing distributions? How did they navigate the hard times? Did they have the foresight to scale back, to Tom's point? Did they have the foresight to start diversifying? Did they make proper financial underwriting and expectations with investors of what happens if we see a pullback in the broader market? So those are the things that I look for when starting the first layers of due diligence. And you can spend 2 hours talking about all the different elements and ways to conduct proper due diligence, but that's really everything at this point. You've got to invest in the people before you invest in the asset, because ultimately they can mess up a good one, and a good operator can save a bad one.
Yep, for sure.
Makes a lot of sense. I have to ask this question. I might already know the answer to it, but Thomas, you guys have done with 32 funds. What asset class do you hate the most that you've been a part of in the past?
Oh man. Without a doubt, it's hospitality for me personally. It's not real estate, it's a business. It's operationally extremely intensive. There's so much variability. You're turning rooms over every night. And the margins, although they pro forma well, there's royalties paid to a flag, unless you're going to go to a non-flagged asset, that's true entrepreneurship. If you're just going to go create something out of the blue, right? Um, it's extremely difficult, and you can't foresee everything. And then just when you think you're getting on top of the world, a COVID comes along and your occupancy drops from 88% to 15% overnight. And I probably have a master's degree now in CMBS debt and securitized debt, navigating things like that. I'm a better person for it. And we got through, but holy cow, man, it taught me a lot of lessons, which have been really good. And I think that it has made me realize, the older that I get, that I wasn't as smart as I thought I was 15 years ago. You've got this kind of this, almost, what I look at is a lot of syndicators, that everything is rosy and everything looks good. And then you come to this peak and then you're down, and then you realize, wow, maybe I don't know this. And then you start gaining this wisdom on the back end. And there's a phenomenon in medicine called the Dunning-Kruger effect that is called this. Like, you can't lose because you're so smart and all these things are happening. But then when you know enough, and I got my MBA, I was like, oh, wow, I don't know if I would have done a lot of this stuff if I would have really known. And now, thankfully, I'm on the other side of this going, okay, what would have I done and what would have I not done? How do I look at this and how do I learn from some of those things? And it's been ungodly helpful. And that's when we look towards the family office, is I look through this with a much, much different lens, because I'm going into this with my own legacy and my own money first. So investors well, we love partners and we love to share and do those things. It's not the primary focus, right? The primary focus is us creating this for legacy, and then to offer these things, because we go so deep and we vet these things so much that we can leverage and we can do much more. And when I say leverage, I don't mean debt necessarily. I mean the common ability to get better returns is a larger pool than smaller, and it gives the ability to do better things. So yeah, hospitality. Long answer to a very easy question, but definitely, yeah, no more hotels, no more.
Well, I've got a couple of friends down the street here who have bought and built 2 hotels, and One they owned for a while, both flagged, and then one they were building to open up during the middle of COVID, and still is not up to where it needs to be in a lot of cases there for you. So a lot of people feeling that way out there.
Yeah.
When you talk about it, using your own money versus using other people's money, it's obviously a little bit of a different mindset when it comes to the deals that you're looking at. I mean, both very, like you both guys have said, but you want stuff that's secure, smart investments, not being risky in a lot of cases. Besides the due diligence aspect of things and the credibility of the seller of the opera, stuff like that, what are you guys looking to buy right now, or do you think there are opportunities? What's kind of in your buy box, I guess, is the best question I'd like to ask.
Yeah. Cole, why don't you do that? I think that, we've got four kind of pockets that we look at now. I'm gonna let him kind of take that, and I'll play cleanup on that.
Sure.
Okay. So for me right now, we've identified a few partners that we already have in place, and then we have our 4 assets. So a partner I can mention now is Mag Capital. They focus on triple net industrial. So this is going to be something like a heavily machined and equipped industrial warehouse that would be very, very expensive for a tenant to deconstruct, move, open up. They've realized they're sitting on millions and millions of dollars in property value and building value, to where they will go sell that off so that they get capital for immediate R&D, marketing, whatever that cash infusion is going to allow the business to do. And now we have a tenant that's does not want to move, that can grow in the space, locked in for 15 years. After 3 to 5 years, sell it to a PE group that rolls those up, and you've got a great return with solid cash flow in the meantime. Very, very resilient against economic downturn as well. So it's one of those ones where we're mitigating exposure to broader economic shifts. So we like that. The next one that we really like is focusing on high growth corridor raw land entitlement, which basically acts as a value add. So you're allowing it to buy in an area where you know the growth is going to, let the market come to you, and sell it with the correct entitlement and zoning at the time when other developments or retail or commercial applications are going in around you. Specifically, we're working with Horizon Capital Partners, Dave Johnson and Mark Smith. They focus on the North Texas corridor of high growth, Denton County, Collin County, Cook County, and Grayson County. Basically look at North DFW all the way up to the Texoma border. That's kind of where they like to play. The next 2 asset classes that we're looking at, one that you're very familiar with, is basically distressed debt, and how do we leverage that to take advantage of what we could see as a market pullback when times get a little bit tough from an economic standpoint. And then the last asset is something else that has another completely out of sync supply and demand profile, which is affordable housing. So I think there is a huge opportunity in the manufactured home community that gives pride of ownership with true community amenities in the actual neighborhoods themselves, so that you're bringing a higher value tenant that hopefully wants to stay there and take care of the property for a long period of time, get away from the stigma of a traditional trailer park that you think of as just something super sketchy and not good from a management and cash flow standpoint. And we're kind of down the road with a few potential operators that we're just vetting and really taking our time to make sure that we're confident in their ability long term to perform.
Awesome. Thomas, you want anything to that?
Yeah, I'm going to add the asterisks on the wisdom section of each one of those, at least 3 out of the 4. So the first one on industrial, and what Cole's explaining is not what you're seeing, depending on where you live and what MSA you are. We're not talking about the millions and millions of square foot of industrial that's going up that is being built on speculation. What we're talking about is specialized niche companies, and this is in a very specific section. And I will say, without getting too deep, because I don't want to give too much, because there's some interesting things that would give this away, but there's a section in real estate and operations that these tenants have a difficult time securing regular bank debt. And so what that allows us to do is to not only increase cash flow, but when going in and making these assets available for them, they're doing it in such an LTV that we're talking like 30-40% of LTV that we're secured on the asset, well over 70%, and they're still playing market or above market because of the difficulty that they get, because some federal regulations, and I'll leave it at that, and state regulations on how they're able to do this. So it is very pro-formable. It's very easy to see the line, and you've got debt securitization on one side, and you have demand on the other side that wiggle. So that's the first thing. The second that we talked about, land entitlement, having tried to do land entitlement myself to build some things early in my career and build an apartment complex, I'll never do it again. It is a very, very specialized sub-segment and requires deep knowledge of not only the raw land, but of relationships in that area that can toggle the switches to get those things done. It can take years to get these things done. It can be very lucrative, but tying in the hospitality back to this specific thing, Dave Johnson is a first of all, a very, very great guy. My family and a lot of business colleagues have known him for a number of years. He was actually the chief executive of a company called BlackBridge Hospitality, which is the largest now hotel third-party manager in the world, I believe. I think they merged with Interstate Hotels about 5 years ago. Dave left, he was on the board, and he actually opened up his own kind of family office, and that's where this comes from. So this is where he's gone with his partners, and a lot that's dealt with that. So these are all very well-connected, high net worth people that we've known for years and have trusted. Third, when he talks about manufactured housing, I think I've mentioned that one of the big things in experience then, and some people that operate mobile home parks is being very careful with what you own and what you don't own. Tenants can be very sticky that own their own facility versus they rent the pad. Owning the homes are a much different ballgame than renting the land underneath. So there's just very, the nuances of those things that I wouldn't just throw them out as, hey, this is what we're doing. There's very specific reasons that we do and don't. One of the biggest things that probably have changed, I wrote a book, I don't know, now about 10 years ago, that was called The Passive Income Position. And the second tagline, this was surviving a career crisis by expanding net worth. And I laugh about that now because net worth is no longer, I don't focus on that. It is, times have changed and net worth is great, but it's on paper. It's cash flow. It's cash flow, stability, and tax efficiency. That's what I care about. Maybe I'm getting older and crankier. I don't know, but it's the predictability. I could care less what something's worth on paper than what I'm getting every month. So anyway.
That makes a lot of sense. Makes a lot of sense there, definitely. You guys have done some amazing things, and raising $100 million in private capital out there is nothing to be shrugged off. What are some of those little things that you think did well for you over time? Because that's not going to be something that you have one meeting and people are writing, $100,000, $500,000 checks right at that. It's building relationships over time in a lot of cases. What are some things that you guys have done to build those relations or nurture those relationships over time?
I think it's proof, first of all, right? It takes 10 years to become an overnight success, essentially. It's a long grind, and you're proving this, you're doing these things consistently, you're living the brand. I mean, that's the biggest thing. You are a brand ambassador of yourself. And I think that, social media has obviously changed a lot in the last 15, 10, Jesus, even 5 years. We're seeing different things. Yeah. And, one of the things that I've been fortunate, I feel like that I never did, and I never lived on social media, which can be a great thing and it can be a bad thing, right?
Right.
We've talked about this before. It can be great, but your digital footprint lives out there, and I think you have to be very genuine, and you have to live that every day. You cannot be fake. And for me personally, I think that people can genuinely sense if you're genuine or not. They know whether you're lying, and whether it's not immediate or it's a year later. I took these things extremely personal. When we had times where we had to stop cash flow or any number of things, if we didn't have an asset that was performing, I mean, I literally lose sleep and years off my life probably, because you take it very personally. But the older you get, the more wise things are going to happen. And what matters more is how you navigate that. Yep. So I think that's what I would say is keep to it and live your brand and live your integrity. And bad things happen, but just slog through it and be genuine. So Cole, I don't know what you'd have to say about that. I imagine similar.
Cole's a little bit younger on it and probably a little bit more on social media and stuff like that. Cole, your thoughts?
I really just feel so strongly about making sure someone is in a position to make this type of investment in the alternative space, that if I even have that weird little feeling, I would just rather not have their money, stay in communication, provide as much education as they want, provide updates, allow them to get even more comfortable with this over a period of time, and then invest 5 years later when they're $1 million net worth richer, or whatever the case may be, just because it's so so scary when you're sending that first $50,000 wire and you're dipping your toe in the water. And if you're not being ultra honest with the people that you're investing in, and you only have $1 million barely scraped together for the net worth to be accredited, or you just barely make 200K a year and you're at that threshold, that's a lot of your portfolio to be tied up in an alt that is
Yeah.
higher risk than traditional equities and bonds.
That's a great point, and one that I recently faced again, and I think sometimes you forget when you get to a different level in life, you forget what those early those early years that, I mean, wow, you barely scraped together 50 grand, and I'm scared to death of even putting that in, putting the money in, going, oh my God, this is massive money. And to what recently, Cole, we talked about this, that I had an investor call that there was a fund that I kind of was involved with that I put some money in. And this person, an elderly person that was a friend of a friend, they called and was trying to put about 3 times the money that I had put in, and saying, well, her husband had passed away, she needed cash flow. And I had to be very frank and say, this is not smart. You need to just go put it in a 5%. You're better off, using it in a high yield checking account or something, gathering 5%, than trying to scrape the difference of maybe a 7 or 8% return. That is way too risky for you. And I could not live with myself. And Cole and I talked about it. I told her no. I was like, no, we're not doing this. Like, I'm sorry. It's just not smart.
Yeah, you've got to definitely trust that sixth sense, that gut in there. If something is off, it's off for a reason, whether it's the person or the investment or their lack of knowledge or experience. You have to sometimes have those hard conversations and say, this isn't a fit for you. I love you, but this isn't a fit.
Yeah, very much so. Yeah. And that's
And
the
big disclosure.
Younger. Yeah. Younger and older. You make that decision before, you're like, no. Okay, all commerce. It's great. No. I have changed drastically on that mark, because people, I still get to this day, people think that it's a certificate of deposit when you're investing in some of these, and it's not. It is not. There are risks. They can be great, and you can mitigate those risks, but you have to understand that you can't just call up in 2 years because things, aren't going great. You've got to navigate through it, and thank God you do, but it takes time.
Cole, you were going to say something there as well?
Just, that's where I always just make a joke too, is like, hey, I'm not a financial advisor. I would not recommend that you do this, but also you should absolutely go ask your financial advisor, because they will straight up tell you you're insane. That's not the type of investment for you to be making right now. And they hear all the stories of like, well, this is how you get rich faster, but like, this is also how you can lose everything. So the risk return profile, to Tom's example, is so not in your favor if you're all in on alts and nothing else in traditional growth or S&P 500 or just whatever, even money market accounts right now at 4 or 5%.
Yeah, it depends on your exit, what your need is.
Yeah.
Right? You're 75 years old. You don't need to worry about.
You're in the preservation pasture.
Right.
You are far end of it.
Right.
Hey, I got some NFTs for you. That's the way.
Exactly. That's great. All in on NFTs, by the way. I mean, I'm just shoving we're going hard.
No, yeah, you also said there, Cole. I think it was also disclose the heck out of everything too. The good, the bad, any possible action on that. So there's no excuse of, if something does go wrong, it's not a surprise in any way. Hey, you signed on this week's disclose. That's definitely important.
Yeah.
And I think that's an opportunity to stand out and be different as well, because every investment in the world has all of the scary stuff as small as possible and buried in the middle of a section that doesn't even make sense for it to be there. I think if you just put the scary stuff in bold red letters right on the first page, it just kind of eases people's mind when they finish reading the rest of the document. They're like, okay, everything else was just kind of BS. That was really the stuff I needed right there on the first page. It just says, hey, look, this is what it is. This is the risk. If you want to do it and it makes sense for your position, fantastic. We'd love to do business with you. If not, no big deal. Stay in touch with us, and hopefully we can in the future. But like, just be transparent. It's not hard.
Ask the hard questions. Don't just go along. The harder the better, right? I mean, I always used to love doing phone calls where, that was always how I closed. Okay, seriously, ask me a really hard question. Like those are the fun ones, because those are the ones you get the chance to express how deeply you've gone into this and what you've done. It's very, very seldom that you find a really vexing question by somebody. And I think today's times, require people to really dive in. And I mean, Jesus, you've got AI. You can go to ChatGPT and upload a PPM, tell it to dissect everything on it. It'll give you it'll spit it out, you know, it'll say, hey, give me 5 questions that I need to ask this guy. You know, force the operator to come to the table with what it is. I think that's the biggest thing. That's the only way you're gonna feel peace of mind when you put your head on that pillow. So
Yeah, exactly. Now, speaking of AI, I know you've been a fan of that and tweaking around some things. We spent some fun times up in Dallas there. What elements are you leveraging AI in your guys' business on the due diligence, on the marketing, on the capital raising side? What are some of the fun things you guys are doing? Or are you still figuring it out like all of
yeah,
us?
no, I'm actually, yeah, both of us have dove in pretty hard on it, and it's been fascinating because the better you prompt and just learning about everything, it's pretty amazing. Cole's been on the leader of that. I mean, we've been even toying with legal things on it. And it's like, well, why do I need a lawyer? We're all gonna need lawyers. I'm gonna say we don't, but it's really amazing what you can do to get around and to hold their feet to the fire too on some things. Yeah. So Cole,
Yeah.
yeah.
Yeah, so I mean, as extreme as literally working on some of the legal language for what will be included in PPMs and subscription docs and disclosure statements down the road, hopefully saving time and money with actual lawyers. But as surface level as just generating AI created images for social media posts, for content, for saying, hey, here's a topic I want to dive into. Can you provide me with 10 recent news articles that would be great to source and include in the post as just either evidence or something that's interesting related to the topic? There are probably an infinite number of ways to keep using it, and it just gets better and better by the day. Every time you log in, there's a new feature, there's a new ability that it has. So I think the ways that we'll be able to leverage it from a client outreach automation standpoint that's even more sophisticated than traditional drip funnels is extremely attractive because we can lower and decrease the annoyance of an email cadence that doesn't have any sophistication to it, where it just blasts it every week or every 2 weeks or whatever the cadence is, versus, okay, if someone is opening every single email, they're going to stay on this cadence because they're giving you signs that this is something that they spend time reading, versus someone that never opens it. Maybe we slow them down and change them to something else that has more like aggressive subject lines so that we can garner attention faster. So I think the marketing elements of AI down the road could be very, very helpful just to like streamline an entire department with sophisticated AI strategies.
I've actually used it like a really knowledgeable business partner lately. I've come across some things on some of our current holdings that we're looking at, and how do I structure something, you know, and I've used our loan covenants and prompted it and gone in there and said, okay, can we create a different structure? How do we need to do this? I've used it on phase ones recently so that I could see, okay, what do I not know that I don't know? And say, I'm looking at this kind of an asset. And it'll pro forma everything. And I've gotten those, but then go one step deeper and like, okay, what would you see that are the pitfalls of this? What am I not seeing? And it'll come up typically with 2 or 3 things. And I'm like, you know what? That is just like having somebody on the other side that's almost a mirror reflection of you that thinks just a little bit different, but it gives something else. And it has been really, really knowledgeable in those things because it's just harvesting data and then spitting it back at you. And it's been quite amazing to use it in those really dense things. Like who reads a phase one, right? An environmental. Those are just things like, unless you're a neurologist or you a different level of a person that you are going to go down there and get in the weeds. Reading loan covenants, that's dense stuff, right? But it will raise flags when you're looking at that. You're talking about, several $1 million in debt structure. What are the things I need to look out for? Because the bank's not going to say, hey, we threw in this clause right here that you can't accept, another level of loan. You can't do pref equity. You can't do all these things. Oh, by the way, you're going to have management approval every time you want to make a change on the property. We've got to say that that's going to happen. So it's been invaluable with those kind of things.
Yeah, being able just alone to highlight those images instead of having to fall asleep at night trying to read.
Totally. And making it
Not,
bite-sized and simple, right?
yeah.
Yeah.
Exactly. When you talk about the deals that you're targeting, I know all four of them have different kind of structure to it, different dollar amounts. If you were to put a buy box down as far as a price point or investment amount or yield that you guys are targeting as kind of your base floor of what you're looking for, where does that lie? What do you guys kind of is looking for those out there that may come across maybe some of those types of deals or could forward those types of deals to you?
Yeah, I would say our minimum, and I'm not even going to throw out the word or the acronym IRR because of, it just is there's too many variabilities with it, and I hate
Sure.
it used nowadays. So I would say, an actual of a 10% return, but there has to be, and that's a minimum probably. Cole, I don't know if we've gotten really granular on this, but what I'm going to look at though is what's the extra kicker on that? Is there how tax efficient is it? How are we looking at this? Are we looking at this as just regular capital gains? Do we have a depreciation aspect? Everybody's going crazy because 100% bonus depreciation is back, which is great, but it's not the only reason to jump headlong into somebody that's buying value add multifamily, in B class right now or C class that's suffering. So there's so many other reasons to go into that, alone aside of the people. The operators are going to be 100% the issue, but Cole, I'll let you speak to that. So.
I think so. On the note of singles and doubles, I've kind of identified what I see very, very commonly in a bunch of other asset classes to say, okay, let's at least try to generate that or better, which is somewhere between an underwriting period of 3 to 5 years on average and a return profile for the multiple of 1.5 to 2.5 on the high side. And that's going to vary based on, are you investing in a dedicated land fund or are you investing in uh, a diversified approach, like one of our products that has 4 different assets that's meant to really, really reduce your risk, spread that risk across other safe assets that are all designed to be resilient. And then that's something that maybe is like a 1.75 over a 4 year period. And we got 10 to 12% cash flow during the whole period. And maybe there's a few tax efficiencies that we're also able to garner through some of those products as well. So uh, it'll obviously vary fund to fund, but that's kind of a buy box range.
Yeah.
Makes sense.
And I think the
Makes
big
sense.
thing that you mentioned there is we've got, in addition to the 4 quadrants, there's the ability to invest solely, but then when you look back at being diversified, which I don't necessarily love that word because, I like to look at it and to cheat a little bit. I want to know where my eggs are and then push it in. So I want to have, I want the edge, right? I want to know where I'm going and I want to be able to harvest that. And so you try and push to a known constant. It's not just throwing dice. But for that very reason, we've also amalgamated that into a single fund that has all 4 of those in there. So you're getting 4 pieces of that pie, which is the way we're doing things.
Yeah, it's
Makes sense.
certainly not like blind mutual fund diversification. This
No.
is highly
Yeah.
targeted.
Yeah.
There's reasons behind each one. And that's where we find, good diversification or smart diversification.
Right.
Yeah, makes a lot of sense there. Makes a lot of sense. Now, obviously, with these four different targets and the individual stuff, are there any geographic areas out there that you really are liking? Obviously, the land entitlements on the Dallas area north, that's kind of specific and stuff like that. But you open to other parts of the country or major MSAs or any areas
Yeah.
you want to stay the heck out of Dodge?
Well, oh yeah. Yeah. We definitely want to stay the heck out of Dodge at a lot of places. And it also depends on what the base fund is, right? Typically the 4 corners of the United States, sans Florida. Well, actually right now, Florida. Yeah. You could probably go pick up some really great real estate in Cape Coral and Punta Gorda. They're 105% overbuilt. But typically, I think it follows the tax efficient, landlord friendly, depending on what you're doing. Because when it's landlord friendly, typically the laws are a little bit more neutral. So not to speak ill of those 4 corners of the United States, or at least 75% of them. But there are certain states that we've always done business in: North, South Carolina, Texas, Tennessee, Georgia, and know those tax bases pretty well and how to navigate them, and what's favorable and what's not about each one of those. Because again, I think for me personally, it all comes back to tax. That's why I started this whole thing 20 years ago, was because of tax. It's not how much you make, it's how much you keep.
Definitely makes a lot of sense. What would you say is the biggest mistake you see people making when they're pitching a deal or pitching investors out there? Anything that they fall flat in their face, or things they do that you just like, or should have done, do more of?
Yeah.
Overpromise.
Okay.
Well, that's a big
Yep.
one. Yeah. And sometimes you can't help that, right? You know, you've done your best, you've pro forma but knowing that you're overpromising, that's a whole other thing. I think comes back to integrity. I think for me, it's the ability and the knowledge set that a lot focus on the capital raising aspect and just to be a capital raiser. And you're starting to see a lot of that come to light because when we talk about syndications, I think that's where the problem started is you're not involved, you don't know the spreadsheet, you're not on the property, you're not dealing deeply and granularly with these assets, which, you know, not all fund managers do on a large fund set. They've got its staff, but when you're talking about a smaller firm, if you don't know this stuff backwards and forwards, why, and know who is operating, why they're operating, it is not a set it and forget it type investment. So I actually shudder when I hear the word, and I hate that I titled the book this a decade ago. You know, passive income. I have learned to just almost, it just feels like a knot to me now. You know, I almost want to use the word residual income because there are such things as passive income, royalties, things like that. There are certain avenues. But it ain't passive. I don't care what level you're at. It's just not. It takes work. So the biggest mistake I see people doing is not understanding, you know, just going in and pitching a deal and not really knowing the pitfalls or not having the skin in game themselves. Are they up at night, you know, at 3 a.m. staring at the clock? I bet a lot of them aren't.
Yeah, exactly. Got to know the ins and outs and where the bodies are hidden, definitely.
Yeah. You're going to have skeletons. I mean, you do it long enough, you're going to,
Yeah.
and you just need to, people just got to understand, you know, that's part of the bruises and part of the wisdom of doing it. And so you don't make those same mistakes twice and mitigating when you do. I think that's the biggest and best thing you can do is you'll triumph in the time when things change. That's when you go attack it again and you get the big swings.
Exactly. And I think there's gonna be a lot of profits, a lot of money made over the next couple of years, guys. Is that
Oh,
your outlook
absolutely.
as well? Yeah.
Yeah, absolutely. I think we're just, you know, everybody's kind of, I mean, we know we're all waiting for that other shoe just to go like, what's going on? It's so odd. You know, you have $1 trillion of bridge debt out there. That's, you know, that's what's going to happen to it. I think there's plenty of capital on the sidelines. It's just, you still have this spread between buy and ask. It ain't coming together yet, but it's gonna, you know.
It's getting closer every day. And I think
Yep.
we'll see more as the closer we get to the fourth quarter here, there can be some hard decisions made by some lenders out
Yeah.
there to get the stuff off their books.
And the smarter ones, you know, we're dumping. You can't hold on and pray. You know, hope has never been a strategy, and you just wait. You know, the bank's going to kick it down. At some point, the bank and the fund are going to get wise. They've got to cut their balance sheet too, right? You're better off just dumping and running. You know, even if you have to sell it an 8, you know, 20% loss, whatever you have to do, it's better than the slow burn of just getting killed because you're throwing bad money after good. And that's what's going to separate the smarter and the more wise operators at the end of the day is nobody is going to be perfect, but you have to make the hard decisions early and not try and put that round peg in a square hole and keep throwing money after money into it because you're going to end up dead.
Got to take the emotion out. Don't go down with the ship. In a lot of cases, there, be smart and get it moved any way you can, right?
Yeah.
Yeah. Guys, it's been wonderful. What's the best way for those out there to connect, follow what you guys are doing over at BlackBridge, the website, your LinkedIn? What's the best way for folks to communicate with if they want to follow?
Yeah, rattle those off, Cole. I know you get on, you know.
Yeah. BlackBridge.financial. BlackBridge.financial is the website that has a link to the books that Tom's written, that has the 4 different asset classes with a little bit of blurbs about each one, any of the partners that are live, some information on them as well. And then if you fill out the contact form, we'll add you to the email list and alert you as new offerings come available here probably in the next few months.
Awesome. We'll make sure to put all that stuff in the description and a link for everybody to be able to connect with you guys.
Yeah, and we're both super easy to get a hold of, probably at our detriment, is we tend to eat, live, and breathe this stuff. And although that's been probably the biggest downside of things is being too available sometimes in the history, but I'm never going to stop doing that because it's just part of the DNA of who we are, that even if somebody's not going to invest, I still like hashing ideas out and hearing perspectives because you never know which one is going to trigger something and go, you know what, I never thought of that. And it's happened before where then you go down a situation where you're either learning something or you're able to make money from something because of an idea. So don't ever be afraid to reach out.
Amen. Sounds good. Well, we appreciate you guys taking time on your busy schedules to jump on the show and share your insight and knowledge and experience here, guys.
Perfect, Scott. Appreciate it.
Anytime. All right, guys, that's going to wrap it up for this episode of the Note Closure Show. As always, take what these guys shared, their years and years of experience, and what they would do, wouldn't do again, is always a great thing. And then where they see opportunities lying and how they are approaching the market. And it's definitely an interesting thing and something you can definitely learn a lot from. So go out, take some action, everybody, and we'll see you at the top. Hey, real estate investors. So you want to dive into the world of note investing, but don't currently have the funds to sign up for an expensive class or a workshop or one-on-one coaching. Well, then you definitely want to check out the biggest bang for your buck in the note world. And that's our WCN membership. It get you an all-you-can-learn access to our class workshop replays, tapes, weekly coaching calls. For $97 a month, it's the biggest bang of the note industry because you get access weekly with me. You can book one-on-one phone calls with me. As we get different tapes in, we'll share them with our members after our one-on-one coaching students get access to us. We share a variety of tools, like I said, replays to the previous workshop, special discount codes to other events that you can take advantage of to help you get more bang out of your dollar every month. We've been investing in notes for over 20 years, and one of my biggest passions is helping note investors, big and small, get started buying notes. Yes, I got started years ago with no money, no savings, and no list. And I love helping people close on their first deal, get their first private funding partner to help them fund more deals and help them both make above average returns. If you're looking for somebody to help you take your note investing from 0 to 60 and want to get started, my WCN membership is a great place to get started. Like I said, we upload lists to it, video training, coaching calls for $97 a month. What can go wrong? The only thing we ask is you hang around for 6 months, and then if you don't like it, you can cancel. But check it out at noteumbrella.com. That's noteumbrella.com. That's our WCN membership. Get looking at assets today. Start putting your fingers on the trigger to pull the trigger on some note deals here before too long. Yes, anybody can buy notes. I don't care your age, your savings, what race, color, whatever it is. Note investing is all about what action you take, and the first action you should take is signing up for our monthly membership at $97 a month. That's noteumbrella.com. You can also access it by going to weekclosenotes.com and checking on the monthly membership. But we are here to help you. Scott Carson, the Note Guy. We look forward to seeing you at the top.